Broadly, we'll discuss the overview of control, how we classify control as preventive, directive, use of flow charts in our day-to-day work, accounting cycle and associated controls, and in the last we'll see what control management puts for day-to-day operations. What is the definition of control? As I told you, previously we were discussing that the control is a process, right? Internal audit or internal control is a process. So the same way, control is any action. You can face a question which of the following is an action, is a process. That's very important definition. Any action taken by management, the board and other parties to manage risk and increase the likelihood that established objective and goal will be met. So that will be called technically as control. Control processes includes policies, procedures. It can be manual or it can be automated. Control process require feedback. So when we put a control, we need feedback on these controls so we can improve ourselves on the result of organizational activity for the purposes of measurement and correction. Control processes include establishing standards, measuring performance, examining the deviations, that is variance analysis, taking corrective action to correct it, and reappraise the standard based on the experience. Primary controls, there are some type of controls. One is preventive control. As we say, prevention is better than cure. So if it is cold outside, I should wear jacket, gloves, otherwise I may affect my body. Same way when we make a company, before we open the company, we put some preventive controls. Then preventive control deter the occurrence of unwanted events like storing petty cash in a locked safe as an example. Detective controls are on the field. For example, inventory or stock count is an example of detective. We have a report from system and we are checking the deviation and discrepancies. So alert the proper people after an unwanted event. They are effective when detection occurs before material harms occurs. The one is corrective controls. Corrective is for correction. Sometimes you are correcting the negative effects of unwanted events. Example is all cost variances over a certain amount must be justified. And directive controls are those controls which are directional in nature. For example, head of CIA, IIA, internal audit head will say all of my employees should go and do CIA examination. That is his directional, Of course, he cannot force. So, cause or encourage the occurrence of a desirable event. These include policy and procedure, employee training, job descriptions. Secondary control are compensatory in nature. Compensatory mitigating controls and complementary controls. And compensatory means that who will compensate the control if you are unable to put a team of internal auditor. I will give you an example. Sometimes we need to be cost efficient. So what we do is we don't maintain a fleet of internal auditor. We give the auditing work technically to the next level of management. For example, junior accountant work will be supervised by senior auditor. Senior auditor work will be chief accountant. Chief accountant will be accounting manager. So this kind of allocation of responsibility ensure mitigation of risk, and this is called compensatory control. May reduce risk when the primary control are ineffective. However, they do not by themselves reduce risk to an acceptable level. So of course they cannot substitute an internal auditor, but still can add value. Complementary works with other control to reduce risk to the acceptable level. In other words, their synergy is more effective than their control by itself. As we say in bread and butter are complementary, made for each other controls. Separating the functions of accounting for and the custody of cash receipt is complemented by obtaining deposit slips validated by the bank. So there's a process. I will receive money from the customer money will go in the bank, so validation will be a complementary ones. We can classify control in other ways. One is online and one is offline. There are some businesses which are online, eBay, or which you can just go online and you can buy. They don't have physical stores. So for that kind of control we need a little bit different atmosphere. For example, if my English is weak, I will write M-A-L-E mail, someone will write M-A-I-L mail, so we can't let people choose. So we use pre-formatting, means drop downs, or not let people enter too much. So I will put financial total, they will record counts, hash totals, then pre-formatting, field check, like did I put alphabet or a digit, valid limit and range, self-checking digits. So these tools I will use in order to maintain my online inputs. Then it will be process. A system has three functions. First you input, like sale invoice, purchase invoice. System will process and then will give you output. What we want to control is whatever entered is authorized and accurate. Whatever is processed was authorized to process and it was accurately processed completely, then the output control will come. So processing control ensures data is complete, accurate during updating, and output control ensures that the processing results are complete, accurate, and properly distributed. We can define these control according to the time classifications as well. Feedback control means they will about anything complete, you will have a feedback on it. Concurrent means both are simultaneously doing. For example, a check by two signatories side by side is concurrent control, and feed forward means that is taking care of your future needs as well, that anticipate and prevent problems in future. We can classify financial versus operating. Financial controls are money based, more financial based, and operating are day-to-day production, sales, in terms of purchase, in terms of quality assurance. Then people based versus system based. People means more human, you need other system, and if there are more machine, you need another kind of system controls. So we use a control matrix. It says control do not necessarily match risk one-to-one. Certain controls may address more than one risk, and more than one control may be needed to adequately address a single risk. So matrix is a mathematic term which has rows and columns. So you see the multi-dimensional side of the risk factors. He give an example: all petty cash custodian must present expense voucher periodically. This control helps that petty cash accounts are maintained at the established level and petty cash expenditures are reviewed for the appropriateness. A control matrix is useful for matching control with risk in their circumstances. We have this matrix is telling risk levels 1, 2, 3, 4. These are 6 risks and these are 4 control situations, and he point out the figures in terms of matrix. There are multiple risks into this scenario.